This is the very strategy that helped me lock 27 loans in one day. It also helped my friend, colleague, and head of faculty, Craig Strent, lock over 100 loans in 1 week. And of course, those stats came from 2020, the most ultimate refi boom of all times. But just a month ago in September, Eric Bible used this exact same strategy to lock 33 loans in 13 days. Of course, the strategy that I'm alluding to here is the strike rate strategy. A strike rate is a conversation that is had with a customer, ideally immediately post-closing of their acquisition or purchase loan, to agree upon the interest rate in which it makes undeniable sense to restructure that indebtedness and refinance that loan. The strike rate represents the agreement that the customer is willing to move forward once interest rates have come down to that level. And today, what I want to teach on is specifically the creation of the total cost analysis presentation, what we call the preparation for the meeting with the client to go over and to get the commitment around the strike rate. So buckle in, we're going to move fast. And by the end of this, you are going to be a ninja in creating strike rate total cost analysis and getting the agreement of the customer on a strike rate. As the great Stoic philosopher Seneca says, good luck happens when preparation meets opportunity. And your ability and willingness to prepare today while interest rates are elevated ahead of the opportunity, which is lower mortgage rates ahead, is going to bring us much good luck. And that's what the strike rate is all about. Determining with the customer and getting agreement before the rate drops. And then they are marketed to death by loan servicers and call centers. So how do we get the agreement from the customer? Well, first, we have to show them the opportunity. We have to give them a compelling upside to come to an agreement on a strike rate, the rate at which it makes sense to restructure that indebtedness. So the tool that we use for this is a total cost analysis. And in most instances, we're going to arrive at a rate or a payment that is going to yield them a break-even point within 24 to 30 months. You have to illustrate the break-even point, show them how long it's going to take them to recoup the costs associated with the refinance. And then we want to show them the opportunity cost, what they would be missing out on if they didn't take advantage of that restructuring of the mortgage. For those of you that are unfamiliar, a TCA is a total cost analysis. It's a financing proposal from a company called Mortgage Coach that enables you to compare and contrast a current mortgage with several other mortgage strategies. This way, we can essentially help the client arrive at the best strategy to restructure that mortgage, and they feel like they have ownership or agency in coming to that decision. One of the things that I've found very important about this process is the customer has to feel like they are in charge. They've arrived at a decision and we're not just dictating a strike rate for them. Our goal is to show the client advice and strategy over just selling them price and rate. You can see in this total cost analysis, we have the current mortgage strategy represented in column 1. We have a new 30-year fixed represented in column 2. We have a 30-year fixed with the client making the same payment in column 3. Of course, that would reduce the term of their loan. Their current trajectory would pay off their loan in 28 years. With this new strategy, they would pay off their loan in 22 years by restructuring that indebtedness and making the same payment. We can also show them taking the excess savings, the $296 a month they would save, and investing that savings into some sort of an investment vehicle, retirement account, 529, 401k, non-qualified retirement account, any type of investment that would yield a higher rate of return than what the cost of the mortgage is, usually makes sense. And with the total cost analysis, you can show how much wealth they're going to gain through that investment. And last but certainly not least, we want to show them that if they restructured that indebtedness to a lower interest rate, but we increased the loan amount so that the payment was the same, we could show them how much cash out they might be able to get when rates get to that lower rate. In this scenario, it shows them being able to get $45,000 cash out. Now, what's important here is not that they want to do cash out. What is important here is that they agree then that if they're not going to pull the $45,000 cash out, but when that interest rate is available, they could at the same payment, they essentially are agreeing that they are overpaying by $45,553 because they could pull that cash out and have the exact same monthly payment. Let me break this down for you in a little greater detail here. And of course, feel free to screenshot this so you have the step-by-steps. Column 1 is the current loan. Column 2 is the rate and term refi at the recommended target rate, showing the monthly savings and the improved cash flow to the borrower. Column 3 is the same rate and term refinance strategy, but simply reinvesting those savings into paying down the mortgage loan and reducing the term of the loan. We want to show in this scenario the total interest savings over the life of the loan. So I would be showing them the cost or payments of the loan over the life of the loan in both scenarios. So I would just say in the TCA, show me over 30 years the cost of each of these loans. And this would show not only a shorter term, but a much lower overall cost if they were to keep that loan to duration. Column 4 is a rate and term refinance, but we're going to invest the savings into some sort of an investment account. I typically use an 8% rate of return. If you look at the S&P historical averages, it's close to 10%, a little north of that, like 10.26%. But I use 8% as a more conservative, and I show them that if you reinvest those savings, even if the cost of your mortgage is 6.49%, if you're reinvesting the savings into something that's growing at 8%, you're growing your wealth more than if you just put those dollars back towards paying down your mortgage payment. And of course, you wouldn't have the liquidity that you would have if you put that money into an investment versus just paying down your mortgage balance. And last but not least, team, I can't tell you how important this column 5 is. This is a cash out strategy with the same payment. Now, I build this at the same interest rate because I'm really not trying to be a proponent for them to pull the $45,000 cash out. What I'm really trying to show them there is, since rates have dropped, you could increase your loan amount by $45,000, have the exact same payment. That is a de facto conclusion that they are overpaying by $45,000 on their current mortgage strategy. And it makes sense, of course, then to restructure that mortgage indebtedness. Armed with that information, you should be able to move from price and rate conversation to an advice conversation where you're guiding the client to make the right decision on how to structure their mortgage and how to invest their savings so that they create the most amount of wealth or the least amount of cost. Now, this is just one of the components inside of the refinance master plan workshop that we've put together. If you'd like to download a copy of the written refinance workshop, you can do so by clicking in the link in the description and get the rest of the pieces of the puzzle to make sure that you have good fortune ahead of you when preparedness meets opportunity and rates come down and you're able to execute on a lot of these strike rates. Remember, the genius is in the execution. I hope that you get after it.